Eric, like many, our next guest expects no change today from the Fed, but says the yield curve will stay near its cyclically, that is, steepest levels because the Fed is being reactive versus proactive when it comes to managing the economy and inflation. We're joined right now by James Caron. He is Global Head of Interest Rate Strategy at Morgan Stanley. Jim, always glad to talk to you. So as long as 8 months ago we were having this debate about the Treasury market being overbought, yet here we are. What is a fixed income investor to do? I mean, just how low can yields go?
Well, there has been a strong demand for bonds and yield and return in this market, and given people's downbeat economic forecasts, in many cases, people expect the Fed to be out of the economy for, I don't know, maybe a period of a year or even 2 years, and some even longer. So people are reaching for yield, and they've done so in the front end. I still think the front end is the safest place to buy, so I'd say the 2-year sector and in. But those who have a little bit more of an aggressive view could maybe extend out as far to 5 years, and that's been a very popular trade. The 5-year point on the curve has actually performed the best, and it actually shows the highest roll down and carry that you can get for a 1-year investment, which is roughly about a 3% return if you were to buy the 5-year at these levels and hold it for 1 year.
Jim, I also know as a larger theme, you say there's a regime change going on at the Fed. What does this mean as far as the balance sheet goes?
Well, effectively, the way that we talk about this is that we argue that the Fed has become a lot more reactive to economic data as opposed to proactive. So if you look at their statements that they've been releasing over the past several weeks and even few months, it's always been contingent upon if data turns, or we will react to data, or something like that. And what that means, essentially, is that even though we have an inflation forecast, say, going out to 2011 for 1.8%, and that's a low level of inflation, the yield curve is probably going to build in a much higher term premium for that, just because we argue that the Fed will allow inflation to arise before they actually try to fight it, and that's what puts a higher term premium into it. As far as the balance sheet goes, when we look at the possibilities of what they could be doing, they could be reinvesting some of their mortgage proceeds back into the U.S. Treasury market. This is something that they've.
Can you handicap that, Jim, on a scale of 1 to 10? How likely is it we hear about that today?
Yeah, today we don't think it happens, so I'm going to put it at less than 50%. It's a close call. You know, maybe it's 45, 55. It's a very, very close call. I just don't think it's been fully vetted in the market yet. We don't know exactly what the market reactions would be, and the Fed tends to want to be very clear about things and not create any disrupting elements in the market, and I think this would be one of those things. So I'm going to say it's a close call, but they're not going to mention. They might have some wording around it, but I don't think they come up with any final decisions today.
And Jim, last question here. Do we hear a hint about potential quantitative easing round 2 for maybe late August, early September?
I don't think that's on the table for this meeting. I think it's way too premature for something like that to occur at this point. It could happen if the economy deteriorates further. That could be something in September.
Jim, thanks as always. Jim Caron joining us there from Morgan Stanley.